Hello and welcome. Happy St. Patrick's Day. Betsy here with Elevate Wealth Advisory. I'm our marketing director, and I'm here today with Rob Fazekas, our director of investment policy. Rob's been an advisor with Elevate for, I think, 11 years now. Is that right, Rob?
That's right. Yeah.
And we're always happy to have Rob on with us today. So thank you so much, Rob. I'll let you take it away.
All right. Thanks, Betsy. Let me go ahead and share my screen now. All right. Well, good afternoon, everybody. And thank you for joining me for today's presentation on how to be a better investor. Um, with that goal in mind, I thought I would just start with a little roadmap and go over the four main areas that we will cover in today's presentation. So we're going to start with the basics and with some basic questions and definitions so that we're all on the same page about why we invest, risks that are involved in investing, and what an investment really is. Then we'll move on to some strategies that people use when it comes to investing and why one of the most common ones tends not to really lead to the best investment outcomes. Then we're going to talk about what we've learned about investing over the decades, the research that's been conducted, and some of the lessons that we can use in our own investments from that research. And then finally, we're going to talk about what to be a better investor, where our focus really should be, and talk about things that are not under our control, but then some things that are under our control that we should focus on in our goal of being a better investor. So let's start with a very basic question, which is why do we invest our money? We choose to do this rather than just spend what we have. We choose to save some of our money or invest some of our money, and there are four main reasons that we decide to do that. And the first one is we would like to grow our wealth and to increase our purchasing power over time. So we would like to be able to spend more in future years and grow what we have. And investing is one way that we can hopefully accomplish that goal. We also invest our money to preserve and protect what we have from the risk primarily of inflation. We know that if we don't invest our money, if we just hold it in cash or just keep it in the mattress, that eventually inflation will erode the value of our wealth and we'll actually have a reduced purchasing power in the future. So investing our money should sort of help us prevent that. And that's one of the main goals. There's also an element of time travel when we think about investing our money, because what we're really doing is shifting some resources that we have in the present and moving those resources to the future to fund goals that we know are going to be in the future, right? So we can sort of predict some things that we'll need to fund in the future, whether that's retirement or healthcare or college or maybe buying a car. And we can outline what those goals are and invest our money with the aim of covering those goals in the future and moving things from today to tomorrow. And then finally, one of the main reasons is to just create options and flexibility. If we have a greater level of wealth, that certainly can improve our convenience, give us some flexibility for the unexpected. And then ultimately, we can use that to create a legacy as well for after we're gone, for our children, for charities that we care about. So these are the four really main reasons why we decide to invest our money. And now, again, sticking with some fundamental basic questions, let's talk about what an investment really is. So when you boil it down to its essential, when you make an investment, what you are buying is really a series of future cash flows. Okay, so sometimes there's just one cash flow. For example, if you were to say buy a piece of property, some real estate, maybe you hold it for a few years and then sell it. In the end, you will receive a cash flow when you make that sale, and so that would just be one cash flow at some point in the future. Other investments, such as a stock that pays a dividend or a bond that pays interest every 6 months, those may have multiple cash flows that go well into the future. The second kind of fundamental characteristic of all investments is there's going to be some uncertainty involved, some risk that is related to those cash flows. Sometimes the risk is very low. If we were to purchase, for example, a treasury bill that's going to mature in a few months, you can be pretty confident that you will receive what you are promised, and that bill will, or that treasury bill will pay you the full maturity value. The risk is very low. There are other investments where the risk is much higher. When you buy, say, a single stock, again, or a piece of property, it can be very uncertain what those cash flows are going to be, when they're going to come, or if they'll arrive as you expected. So there's definitely some risk, and that's just kind of part of the game when it comes to making investments. A third fundamental characteristic is all true investments have a positive expected return. So that doesn't mean that you'll definitely have a positive return when you make it, but when you decide to make an investment, you do expect to make money and have a positive return. If not, you probably wouldn't make that investment, right? If you thought the expected return was negative, you would wait maybe for the price to come down, and that could possibly turn the return from a negative to a positive. But you probably wouldn't make that investment today if you really believe that you would lose money. Now, there is one exception to that, and that is some people do sort of use their money to make a negative expected return investment, but we don't call it investments. We tend to call that gambling, right? Because it's entertaining, right? If you go to a casino and you play casino games, we don't really expect to win. We might, but that's not really the expectation. So we're not doing that as an investment to make money. That's more for entertainment, and we often refer to that as gambling. So that's really the distinguishing characteristic then between investing and gambling is an investment has a positive expected return, whereas gambling has a negative expected return. So I mentioned before that all investing means taking some level of risk. And I'm going to give an example here from a chart I found from A Wealth of Common Sense, showing the returns on the S&P 500 stock index going back to 1990. We've got calendar year returns on this chart, which you can see from kind of those purple colored bars, which shows what the return was at the end of each calendar year from 1990 until 2026. So what you can see is the market tends to have positive returns. Not every year is positive, but about 3 out of every 4 is positive. But what's interesting is this chart also shows something else, which is it shows what the largest drawdown was in the S&P 500 each year, also going back to 1990, and you can see that looking at those gray diamond shapes. So what you'll notice is that even in calendar years that end up strongly positive, there's some point during the year where the market is down, and sometimes it's down quite a bit. 5-10% is very common, but sometimes it's more than that. If you look at 2020, that's an interesting example. In 2020, the S&P 500 actually ended up a positive 16%. So at the end of the year on December 31st, the calendar year full return was plus 16. So it was a good year. But notice that at some point during that year, which was actually in March, as COVID was unfolding, the market was down 34% at its low point in March of 2020. So what this chart really demonstrates is the risk of investing, because we know that the market will go down at some point in every year that you make an investment, say in the S&P 500, even if ultimately you'll end up with a positive return at the end of the year. It's just a risk that we need to get comfortable with because stocks are volatile. And this chart really kind of demonstrates those intra-year swings that we see year to year. Now, while investing involves taking risks, if we don't invest our money, that is also taking a risk too. And I mentioned this before, and that's really the risk of inflation. We know that a dollar today is very likely to be worth less in the future. This is something that's been going on really since the beginning of our nation. And you can look at this in over a century of data, just looking at the slow but steady erosion of purchasing power of cash. So not investing your money will bring about that risk of inflation, which is one of the goals that investing is meant to mitigate. So shifting gears a little bit now and moving on to the next section, we're going to talk now about some strategies that people use when it comes to investing, both sort of individuals and also professional money managers. So some strategies that people use when they invest their money is sort of using their emotions. They may invest more when they're optimistic, and they may invest less or sell when they feel fear or just less optimism. Sometimes people will hear stories or rumors or tips from people they know and maybe act on that when they make investments. You can follow headlines in the news, which could be positive or negative, and possibly make investment decisions based on what's going on in the world, in the economy. Or, and this is probably the most common one, making predictions, trying to outguess the market or trying to figure out what the next move will be. This is a very common strategy, and this is a strategy that both individuals and professional money managers will use. But a disciplined approach is really designed to avoid these mistakes, which we'll talk about when we get a little bit deeper into other investment strategies as well. But just following on that making predictions strategy. So this chart here kind of outlines what this looks like if we were to consider a strategy where you select certain stocks that you predict will do well, and maybe you avoid stocks that you think are not going to do well. This is a very conventional approach. Sometimes it's called active management or stock selection. And again, a lot of professionals will use this approach when they manage portfolios for retail investors. If you look at this chart, all the little circles represent individual stocks in the market. So there's hundreds or even thousands of potential companies out there. And this conventional approach will choose a very small subset of all those stocks that the manager or the investor believes will outperform, will do well, and maybe they will buy a small portfolio of those green dots that they think will outperform the market, and then the red dots denote securities that they want to avoid, or maybe they'll sell or bet that they will go down. And so this is, like I said, it's a common strategy, but it's a difficult one to pursue in the long run. And we have a lot of evidence now that this is not a winning strategy in most cases. So if we look at mutual funds that follow this conventional approach, and we track them over a longer period of time, and this chart shows a 20-year period from 2004 to 2023, what we see is that most of those kinds of funds actually don't even survive until the end of that 20-year period. So only 45% of those funds are actually still in existence when we're talking about equity funds at the end of the 20-year period. And again, only 18% actually end up beating their benchmark and are considered winners. So the vast majority of funds end up underperforming or even closing down. And the numbers are similar on the fixed income side, which is the bond market. We also see a very small number of winners. And again, most funds do not survive the full 20-year period. So that's a tough business, trying to outguess the market and make predictions. And but fortunately, that's not a strategy that everybody needs to pursue for success. So we're going to talk about maybe some better strategies as we move on. So before we get started, then, before you become an investor, one of the most important questions to ask yourself is, do you have an investment philosophy? And what is that philosophy? Now, why is that important? So first of all, I'll define what it is I'm talking about and talk about what an investment philosophy is. And then I'll talk about why it's important to have one. So an investment philosophy is a set of core beliefs about how markets work and how investors should participate in them for the best possible investment experience. There's a lot of different investment philosophies out there, but they're very important to have one because markets are, constantly changing, and strategies, even good strategies, do not work in every period. And you're even with a good strategy, you'll feel that the market is testing you. You'll feel that your strategy is not working, and we all need to go through some challenging market environments. When we're going through those kind of difficult periods where it feels like nothing's working, it's really important to have a guiding, rational principle that we can fall back on as our anchor, so that we understand how markets and investing should work, and so that we can stick to this philosophy and understand that this is a short-term period that we need to endure. But that we have a good set of guiding principles that will work over the long run. And probably the most important thing about an investment philosophy is not just to have one, but to be able to stick to it. Like I said, there will be challenging market environments where you'll be doubtful that things are working. But if you've got a really good, sound philosophy, that'll help you stick to it and not make a lot of changes in your portfolio that'll more likely to lead to poor outcomes and high transaction costs. So what have we learned about investing over the years? And the answer is quite a bit, and we'll go through a couple of the highlights. And one of the first interesting things about investing that we were able to learn, particularly about markets, goes back more than a century now. And this is a story from 1906 when a statistician and scientist named Sir Francis Galton found himself at a livestock fair and noticed that there was a contest at that fair to guess the weight of an ox. Now, Mr. Galton didn't enter the contest himself, but at the end of the contest, he did something interesting. He asked if he could see all the guesses that were made and actually gather them up, all the pieces of paper where people had made their guesses for the weight of that ox. And he took those home and did some analysis on those guesses. And what he found was that the median guess of all the guesses was actually very, very close to the actual weight of that ox. And it was closer than really any other individual guess that anybody made. And that was one of the first kind of interesting insights about how markets work. And he referred to that as the wisdom of crowds, where the market itself actually can be wiser than any individual participant in that. Now, today, we know that markets are very, very good at digesting information. Again, taking that early lesson from Sir Francis Galton and applying it to modern markets today, we understand that markets are incorporating the combined knowledge of all participants. And because there is a tremendous amount of trading that goes on every single day, we're actually getting close to almost $1 trillion in trading volume per day that changes hands among global stock markets. With all that liquidity, and these markets are open 24/7, and people are trading very high volumes all the time. Markets are able to adjust very, very quickly to new information. And that new information shows up in prices. So we see that reflected. That's why prices are changing all the time. It's because new information is coming into the market, and the markets are repricing all the securities to account for that new information. And it's just a very quick and efficient process. And when markets are functioning correctly, they use that knowledge not only to set prices, but to set expected returns for all securities in the market. So if a security is maybe a higher risk, the price will be set lower so that the expected return is higher on that, because we're going to the market understands that in order to entice the next new buyer, the marginal buyer, to purchase a riskier security, the expected future return needs to be higher. And so that means the price will be set lower. So markets are doing this all the time, like I said, 24/7. And it's a really fascinating process. And it's one that really we can use to our advantage. We don't really need to try to outguess that. We can actually just use that and understand that that prices and expected returns are set in a good process that actually allows us to have success at investing, and we can kind of see that on this slide. If we, rather than try to make predictions and try to outguess the market, if we kind of sit back and actually let all those market participants work for you, you can actually be rewarded as a patient long-term investor. And we see that, decade after decade, that markets reward patient long-term investors. This chart here shows the returns to different asset classes over the last 50 years, with the blue, the top part of the chart showing U.S. stock returns, large company stocks and small company stocks. And so just to give an example, if a person had invested $1 in the U.S. large stock market, say the S&P 500 or something like that, back in 1975, and had just held it and did nothing else, that single dollar has grown to $341 over the last 50 years, which is really a tremendous return for just sort of passively investing in a market and not making any trades and not really doing anything and just waiting. And what we also see on this chart is that there's risk involved in investing, right? We saw that before on an earlier chart, but you can really see it here too. The lines, the return lines for U.S. small stocks and U.S. large stocks are quite jagged. You see a lot of ups and downs. You see a lot of volatility, and that's risk. And you can really see it there. Stocks are risky. They move up and down, and it can be difficult sometimes to hang on to those investments as they're swinging around kind of wildly. But you can also see a real pattern from the left to the right side of the chart that even though markets go up and down, they tend to move higher over the long run. And so we just sometimes need some patience and a long holding period. The chart also shows returns for some safer investments like US Treasury bills and long-term government bonds. And you can see the return lines there are not nearly as jagged, right? They're a lot smoother, especially the US Treasury bill line, which is that gray part of the chart. It's almost completely flat. There's very little movement up and down. But at the same time, the return has been a lot more modest, right? $1 has only grown to $8 over that same 50-year time period. So this chart really shows that deep connection between risk and return, where riskier securities have higher expected returns, whereas safer, low-risk securities like a US Treasury bill has much lower expected returns. So again, we've learned a lot about how markets work from all the academic research that's been conducted in this area, going back to the 1950s with the invention of the computer and the ability to look at big data sets. And again, a lot of this research has won Nobel Prizes. And the nice thing is we're able to use this in our own portfolios. This research is free to the public. And we can incorporate some of the most important and useful lessons from this research in our own investments to hopefully become a better investor and have a good investment experience. So one of the key findings in all of this research has been uncovering some other drivers of expected returns. So we've talked about the market return, which is the difference between stocks and bonds. And we see that just being a stock investor, you should earn an extra premium for taking on that risk. And we've seen that a couple charts ago showing how much more the stock market has delivered than the bond market over time. And so that's that main factor. But there are other ones too that they've uncovered, and three of them in the stock market are listed here. The size of a company matters, whereas small company stocks have outperformed large company stocks over the long run. Relative price is also a factor where value companies have outperformed growth. And then highly profitable companies also seem to be its own separate factor where profitable companies have higher expected returns. And so we can see here sort of how large these factors have been over time, and they're pretty significant, and they're pervasive. They show up not just in the US, but in the middle of the chart, you can see that they also show up in developed market economies outside of the US, and even in emerging market stocks. We see the same pattern where company size and value stocks and profitable companies outperform by a couple of percent, 2, 3, 4% over time. And these are factors above and beyond just the market factors. So you can do better than just the market if you structure a portfolio to capture some of these other factors. And so this chart just shows you kind of how large those other factors could be. One thing to keep in mind is those factors are kind of lumpy in the history of returns. They don't show up every single year. There can actually be dry spells of multiple years where we do not see a positive premium to some of these factors. So again, having a long-term patient outlook certainly helps in capturing these factors because they don't show up all the time every year. Another lesson from the research that's been conducted is that we should consider investing outside of our own home country. Even though the United States is the largest stock market in the world and it represents almost 2/3 of the entire global stock market, that still leaves more than a third of potential investments outside of the US. And these markets also have high expected returns, and they don't move the same way at the same time that the US market does. So we can gain a diversification benefit in our portfolio if we include outside countries, both developed and emerging, beyond just the US market. And we can have then a portfolio with less volatility and a smoother ride if we include some of those other countries. And another reason to consider foreign countries in our portfolios is the United States is rarely the very best performing market in any given year. And we see that on this chart here. This is a 20-year look at different countries and what their returns were in each calendar year from 2003 through 2022. And the chart is ranked from highest to lowest. So at the top of the chart, we see the best performing countries, and at the bottom of this chart are the worst performing countries in each year. And a couple of interesting things. I mean, first of all, you see there's no pattern to the chart. It's just kind of a scatter shot. No real way to predict ahead of time which country will do well and which country will do poorly. And the other interesting thing is that in this entire 20-year period of returns, the United States was the best performing market only once in 2014. We see that the US was the best market, but in every other year, some other country actually outperformed, or sometimes multiple countries outperformed the US. And the US market is sometimes towards the top. We had some good years there in 2019, 2020, 2021. The US was one of the top performing markets around the world. But if you look kind of at the beginning of the chart, in the early to mid 2000s, the U.S. was one of the worst performing markets, and you see it there at the bottom of the chart, whereas other markets were doing much better. So again, when we diversify globally, we're hoping for a smoother ride, but we'd also like to make sure that you have the best performing markets in your portfolio, even though we can't predict what those will be. But if we hold a globally diversified portfolio, you will hold those markets in your portfolio at all times. Another lesson is to try to resist chasing past performance. You'll see either individual stocks doing well, or maybe mutual funds doing well. And what we see is that the best performing assets in prior periods are often not the best performing assets in future periods. So we see that pretty clearly with mutual fund data. If you look at say the last 5 years, and you rank mutual funds based on their past performance, and you try to stick with maybe the top 25% of outperformers, it turns out that performance does not persist into the next 5-year period, and it kind of reverts back to the normal pattern where those funds look a lot like what they looked like before, and it's something that doesn't persist to the next period. So chasing past performance is probably not likely to be a good strategy in the long run. Another lesson is to try not to invest with your emotions. And this one's very difficult because we're all kind of hardwired with some base emotions of fear and greed. And often when we're feeling the most optimistic or the most greedy, and we want to invest more, that's often not the very best time in terms of timing market moves to make more aggressive investing decisions. And at the same time, after maybe a downturn in the market, or maybe the economy, it looks like it might go into a recession or looks weak, and people have a little more fear because the market hasn't been doing well, that's often the time that people think about selling or maybe backing off their investing. But sometimes that's actually a better opportunity as far as future returns. So if we can, it's great to try to take emotions out of our investing decisions, even though that's a very difficult thing to do. Another lesson is we certainly want to try to diversify our portfolio effectively. And we do that by combining different assets with different return patterns. Hopefully we can find some assets that move differently. And so that when one asset is doing well and another asset's doing poorly, Together, again, you've got kind of a smoother ride in your portfolio and less volatility, and which helps us maintain that long-term focus. And one of the easiest ways to do that, from the perspective of a stock portfolio investor, is to just include some high quality short-term bonds like 5-year government bonds in your portfolio. They tend to be good diversifiers against the stock market. Not every year, because nothing works all the time, but often you'll see in years where the stock market does poorly, short-term high quality bonds do well, and vice versa. When the stock market's doing really well, that might be a year where bonds are not the best performers. But again, they act as really good diversifiers, and they also give you some ballast in your portfolios for rebalancing. When we get to periods where the stock market might not be doing well, we can use the funds that are invested in bonds to rebalance and get your portfolio back to target. So that's another reason to include multiple asset classes. We should also, again, to the best of our ability, try to ignore the headlines, the financial media. The financial media is not really there to make you a better investor. It's really there to sell advertisements and to keep your attention. So just to be aware of that, if we really just kind of follow the headlines, there's always something going on that can lead to that fear emotion, and something in the news that maybe gives us pause or makes us think that now is maybe not the best time to make an investment. This happens all the time, but for people that can kind of tune that out and try to ignore that to the best of our ability, over time, markets keep climbing higher. They may go down in the short run based on unexpected news events, but they tend to recover given enough time. And for those that just kind of ignore that and just hold on and have a long-term disciplined view, they tend to trade less often, have fewer transaction costs, and have a better long-term return than those that are trying to trade based on what the news flow is of the day. And finally, we should try to focus on what we can control. Some things are under our control, some things are not. One thing that's not under our control is what the market is going to do, right? As much as we'd like to be able to control that, that's really not under our control. Markets are going to go up and down. They're going to be unpredictable, and we just kind of have to get comfortable with that. But there are things that we can do, and that's really where our focus should be if we want to be a better investor. So we can start by making a plan and make sure that our investments fit our needs and our goals and our risk tolerance. We can also structure the portfolio among those dimensions of expected returns that I talked about earlier, having enough exposure to the market and some of those other factors that will hopefully drive higher returns. We can diversify our portfolio globally. That's under our control, so we can make that choice. We can try to manage expenses by keeping costs low, choosing our investment funds wisely, so that we're not overpaying for management fees, so that we're not trading too often, and keeping an eye on taxes, capital gains, and trying to minimize those to the extent possible, maybe offsetting gains and losses if we can to save some taxes. We do have control over that. And then we want to stay disciplined through market dips and swings. We know that the stock market is volatile. We know there's going to be ups and downs every single year. So we have to try to get comfortable with that as well and stay disciplined. And just to end here with the key takeaways from today's presentation, we talked about what the purpose of investing really is. And we talked about some of the goals, the reasons why we invest, to gain purchasing power. We know that investing involves risks that can't be avoided, but we can certainly manage those risks and choose how much risk we want to take and how much risk we're comfortable taking in our portfolio. We know that markets are very difficult to outguess. It's unlikely to be a very good long-term strategy to try to base investing based on predictions. So you really want the process in place, which probably matters more. We want to diversify across different securities, different types of asset classes, different regions of the world, because that's going to give us uncorrelated return drivers and a portfolio, hopefully, excuse me, with less volatility. And we know that being a disciplined investor should make us a better investor as well. So I'll stop there and I will open it up to any questions if there are any.
Thank you so much, Rob. We have a chat box and a Q&A box if anybody has a question for Rob. I always enjoy your presentations and I always come away feeling just so much better about the world and how it might affect portfolios. So thank you. In that vein, with everything that's been going on recently in the news and all that's happening in Iran, do you have any updates on how markets are doing or any wisdom to share regarding that as well?
Well, sure. So we've definitely seen some volatility in markets since the outbreak of the conflict in Iran, which was coming up on maybe 2.5 weeks ago. So the biggest impact so far has certainly been on energy markets. So we've seen the price of crude oil up about 50% since the end of February. So there's been a big move there because that's a part of the world that's very important to energy exports, and Iran is a major supplier. We've also seen the price of gasoline up, not as much as oil. Gasoline's up about 25% per gallon. But that's obviously going to be quite impacted by the price of crude oil. And then we've seen some volatility in the stock market and the bond market as well. So stocks are down about, well, in the US, they're down maybe about 4%. So it's actually been pretty well contained, at least as far as the US is concerned, in the stock market. We've seen a bigger impact in foreign markets, actually. And part of that is because the US dollar has strengthened. It's kind of a flight to quality. And so when the dollar goes up, that impacts what US investors get as far as a return on their foreign investing. And then some foreign markets are more sensitive because they're oil and energy importers. With high energy prices, it might impact their economy a little bit more than it's going to impact the US economy. And lastly, we've seen some impact on interest rates. They've gone higher as the market is a little concerned about maybe the inflationary impact of higher energy prices. And so it's hard to make predictions, but it really all depends on how long this lasts. But I'd say it's been fairly contained, certainly with US stocks so far.
Good news so far. Well, like you were saying, the most important thing to remember is focus on what you can control and just be patient, and just you'll be rewarded for your patience.
Right, exactly.
Right. Well, thank you so much, Rob. We always love having you on with us. We really appreciate the time today. And if anyone has any questions for Rob or would like to follow up later, you can email marketing@elevate-wealth.com and we'll make sure Rob gets your questions answered. Thanks so much. And we'll look forward to seeing you all next week or next month when we focus on cybersecurity. We'll see you then. Thanks so much. Bye, Rob.
Bye.